Hey, good morning, everyone. Marty Mazura here. Roughly 9 o'clock Monday morning, the 16th of March, 2020. Another epic day among many of late in the market. The market opened with a circuit breaker down more than 7%. So, halt of trading immediately for 15 minutes. Then it came back. I actually kind of thought we'd go to the next level the way it was trading and hit the 13. But we meandered around a while, and then the White House, first of all, announced an emergency meeting, and then announced, no, we're going to wait till be 3:30 New York time, so half hour before the market closes. And it just so happens that their willingness to delay corresponded with the market rebounding a bit on the maybe the note or the announcement that there would be an emergency meeting. So, folks, obviously, what we're seeing is traders positioning on a very short-term basis. Right now, they're kind of hoping for a last Friday, perhaps, because it was a White House press conference that seemed to be the catalyst for what was the best one day since 19 or since 2008. As I've mentioned in a couple of videos, we've had too many of those since 2008 lately when you think about the market in 2008. So the reality on the ground is that the economy is shutting down, as you know. And anyone who would say that we're not going to have a recession is either not in touch with reality or just wants people to believe we're not going to have a recession because they don't want to scare them. Well, I think most people should be able to figure that out by now. The question is, what happens next? So I think this goes without saying. In fact, I know it goes without saying, and you would agree, although I can't tell you the time frame. And that is at some time, at some point in the future, either the not too distant future or the further distant future, we'll be looking back and saying, wow, what a period that was. And wouldn't you know it, people are upgrading their cell phones and going out to dinner and buying new cars and putting new tires on those cars and all of those good things. That's inevitable. The question is, what happens in the meantime? How much pain do we feel as a result of, what this virus has done to the economy? Well, think about what happens next. So the Fed has basically unplugged all the plugs, even bank reserve requirements, and is making cash available at virtually every corner, in virtually every corner that it's needed, using more than one facility to do that. The federal government announced, a big spending bill as it relates to coronavirus resources. They've yet to unveil, a real economic stimulus plan that would probably include some infrastructure spending and so on. That's all coming. They may hint to that this afternoon. These things take time. They have to pass certain hurdles and so forth. But the goal this afternoon is to say something to stable the financial markets. Clearly, the fact that the traders are willing to buy the prospects for an announcement says that maybe the fiscal part of it will calm markets a bit. You know my feelings on the corporate debt sector. That's not mystery to the Fed. It hasn't been, and it actually largely explains a lot of the easiness that we've seen of late. They won't talk about that because it's kind of scary. So their goal is going to be to support that market so it doesn't blow up all over us like 2008 did. So we're going to see, obviously, how this all unfolds. You could make the case. I saw a headline where the Secretary Mnuchin said there will be a lot of pent-up demand when this is over. That may be the one thing that I agree that he has said lately, and that is that when you square the fact that we kind of came into this with, let's say 3.5% unemployment. You want to look at it on the bright side with a consumer who was working, right, and felt pretty good about things. My contention was that the industrial sector was showing the kind of cracks that means pain is ultimately coming to the consumer in the not too distant future, hence some changes we made in the portfolios. But for the time being, just imagine coming through this with just the most phenomenal amount of stimulus that the economy has ever seen. So I think there is a legitimate case to be made that maybe the second half of this year, once the virus calms down, that we do see some acceleration to the upside. I'm not saying that we're going to feel great about jumping on that bandwagon. Of course, we will make our analysis and assess, conditions and do what we always do. We have a process that dictates how we act, and we'd like to believe that keeps us out of trouble, but we'd also like to believe it allows us to make money when money's to be made. So anyway, folks, I just wanted to pop in and offer maybe a glimmer of sunshine further out. In the meantime, we should expect a lot more volatility. And my best guess is that some more pain. I'd be surprised. You do have a chart up here, this 3-year S&P 500 chart. There's that 2016 low. We just about touched it. Some people think there'll be some support there, and looks like we couldn't quite get there, and the market did rally off of that. You can see it's coming back a little bit here. 25.41 got down to a lot lower than that. But if we break through there, there's not much support below there for a while. I've heard people talking about 2000 on the S&P as a technical support level. Those of you who have portfolios of size enough to have the put protection, we're looking at that as I suggested the other day. We don't have to do anything. We can let this thing run and then just buy a new put going out a few months if we let it go to April. Right now, we are still looking at rolling it forward, maybe to July. The thing is, if we sell this expensive put, we're going to buy an expensive put. So we're also looking at numbers where we go down and we sell a put contract way down below, collect enough premium to pay for the new one. Most important thing of all, though, is not whether we capture gains now or so forth, but that it's on for those portfolios that can hold it while we have all this uncertainty out there. We did tweak the core mix a little bit today. I got us out of the euro and the pound, maybe for obvious reasons. We're just going to hold that in cash for the time being. We do see some opportunities developing at some point, hopefully in the not too distant future, that we'll want to avail ourselves of. Also lowered our European exposure, took a little of that to cash, and increased some exposure to the Asia Pacific region. Justification there is if you think about how this thing is unfolding, South Korea is beginning to look pretty good. China is getting back to work. Apple's opened all of its China stores again. So emerging markets, Asia Pacific, I do think we could see some money flow to those stock markets as those economies begin to get back up and running. Looks like the way to get over this coronavirus is to stay away from each other. And of course, that opens up the prospects for it coming back the next flu season, because we're not going to build up mass immunity if we keep ourselves from catching it. A vaccine is going to be key as well. So I don't know enough to really speak intelligently about viruses and so forth, other than what I've been reading and listening to, and pretty good chance that we're going to see the coronavirus again. We just need to see it with a vaccine at the same time, and that takes some time. So we'll continue to make adjustments where we deem necessary, and just continue taking it one day at a time. Appreciate you guys. Thank you as always for watching and listening. Talk to you soon. Bye-bye.